November 15th, 2017, New York City Retirement Systems Common Investment. We're going to start by calling the rolls, that is.
Microphone.
Oh, sorry. Do I need to start over again?
We're going to start with, and then continue. Take two.
Take two. Okay, sorry. My apologies. Good morning, everyone. Welcome to the November 15th, 2017 New York City Retirement Systems Common Investment Meeting. We're going to start by calling the rolls. Let's start with the Fire Pension Fund. Who's calling the roll over there? Doug?
Yeah, I'll do it, yeah. John Adler,
Yes, I'm here.
Suzanne Vickers,
Here.
Antonio Rodriguez,
Here.
Gerard Fitzgerald,
Leroy McGinnis with Gerard Fitzgerald proxy.
Leroy McGinnis,
Here.
Eddie Brown,
Here.
John Kelly,
Eddie Brown is John Kelly's proxy.
Thomas Phelan,
Here.
Jack Kelty,
John Farina has Jack Kelty's proxy.
John Farina,
Here.
Paul Mannix,
Here.
and Doug White. We have a quorum.
Thank you, Mr. White, Commissioner White. Let's move to police. Who's calling the roll for police?
Kevin Holleran,
Thank you, Kevin.
representing the PBA.
Joe Alejandro, designee for Patrick Lynch and John Puglisi.
Dan Torelli, proxy for Mubarak Abdul-Jabbar.
Mara Riley from the PBA.
And we also want to congratulate Antonio for the birth of his daughter. So, Antonio. And as I told him, I'm hoping that she looks like her mother. So, that's okay.
Antoniette.
DEA,
Michael Palladino, DEA.
SBA,
Gary DeRosa, designee for Ed Mullins.
LBA,
Lou Turco.
CEA,
Roy Richter.
Finance,
Antonio Rodriguez, designee for Finance Commissioner Jock Jiha.
Mayor,
John Adler, designee for Mayor Bill de Blasio.
Comptroller,
John Dorsett, designee for Comptroller Scott Stringer.
and the Police Commissioner.
Stephanie Zimberg, designee for Police Commissioner O'Neill.
We have a quorum.
Thank you, Kevin. Now, NICERS, Karen?
Karen Mazza from NICERS. Chair.
John Adler, present.
Controller's Office. Here. Public Advocate's Office.
Good morning, Umair Khan for the Public Advocate.
Borough President Manhattan.
Here.
Borough President Brooklyn. Borough President Queens. Borough President Staten Island.
Present.
Borough President Bronx. International Brotherhood of Teamsters.
Here.
Transport Workers Union.
Here.
District Council 37.
Present.
We have a quorum.
Thank you, Karen. And for BRRS, Sandy Rich?
Morning, Mr. Adler. We're represented today by Co-Chairman Ray Orlando and Trustee Isaac Carmignani. We do not have a quorum, but we will administer this business at our next Board of Trustees meeting November 28th.
Thank you, Sandy. Let me just note that the Teachers Retirement System will be coming in later because they did not hire our first presenter here along with the other funds. Just a couple of other notes before we proceed. First off, I would like to ask for a moment of silence to honor Richard Simon, the Deputy General Counsel for the Controller's Office, who passed away suddenly last week. Richard was a major presence, mostly behind the scenes for the funds, and I know he will be missed. Could we just be silent for a moment? Thank you. Thank you very much. Next, I'd like to welcome back Larry Schimmel, who has had a bout of illness, representative for the Public Advocate at NICERS. Larry's back with us over there. Thanks. Welcome back, Larry. Good to see you. Okay, let me just go through the schedule here. We have a presentation in public session first off this morning, and then before we go out of public, we'll convene Teachers Retirement System. We'll have a break, and we'll then ask to go into executive session. We'll have a break, and then we'll do our executive session business up here. We'll then break for lunch, and a couple of the funds will be up here for a manager presentation. Everybody else will go downstairs for their caucuses, and then the funds who are up here will also do their caucuses, and then we'll report out from the rooms. Okay, that's sort of our standard schedule at this point. Okay, and then with that, let's move into our first presentation, and I think Jimmy Yan's going to take us away.
Hi, my name is Jimmy Yan. I'm with the Bureau of Asset Management. So on behalf of, I'm here to introduce Mercer. As you may recall, in last year in 2016, on behalf of NYSERS, police, fire, and BERS, the Controller's Office issued an RFP to select an investment consultant to help consider whether and how we could address climate change as an investment risk and source of impact on the system's portfolios. The board selected Mercer Investment Consulting in late 2016. We came to the boards for that. Mercer is regarded as a global leader in climate change investment consulting. The RFP and Mercer's contract covers three main areas of work. First, there's a best practice review of peer pension funds. Then it's a broad set of recommendations on whether and how we can integrate climate change investment risk into our investment policy, asset allocation, manager selection, and risk management. And lastly, there are some recommendations on prudent investment strategies to address the risks and opportunities that are created by climate change. Today's presentation is the first of two that Mercer will make to the boards. Today, Mercer will give a brief overview of what they're doing for us and present findings from their best practice review and their climate change scenario analysis. About the climate change scenario analysis, that's a unique tool that Mercer has that assesses how a portfolio and asset classes might be affected under different climate change scenarios. For example, an increase of 2 degrees, 3 degrees, and 4 degrees in the temperature. Please keep in mind that this tool is not meant to be prescriptive of what we should do, but is a it is a high-level framework for comparing sensitivities of different asset classes to possible changes in climate and the environment. So Mercer will explain their scenario and sensitivity analysis, and you can ask them questions about that then. So Mercer will come back for their second presentation early next year with a full presentation at the completion of their work. So let me introduce, we have two the leaders from Mercer, Jane Ambashear and Alex Bernhardt. So I'll just ask them to come up for the presentation.
Great. Thank you, Jimmy. It's a pleasure to be here today. Good morning, everyone. So I'm going to kick off with the first part of the presentation to talk about some of the global best practices that we've seen. So as Jimmy mentioned, just in terms of the project overview, putting a little bit of a timeline around the scope that Jimmy mentioned, we've completed the review of the best practices among a range of peers. You have received the report, and we're going to talk through those findings today and have an opportunity to have a discussion about that. Today, we're also going to, my colleague Alex will present the overall framework that we use for assessing the sensitivity of your asset allocation to different climate scenarios and really introduce that, again, giving an opportunity to ask any questions, talk about how that model works, which will really kind of lay the groundwork for when we come back in January to talk about next steps and the opportunities for you in terms of putting the next phase of your climate risk management strategy into place. So with that, I'm going to move into the key findings from the best practices review. Now, to undertake this review, we put together a group of 8 peers, including 3 large U.S. funds and 5 European peers. They were selected based on a number of criteria, as shown here on the slide. Clearly, there are existing practices around managing climate-related risks and opportunities was a key component, but also that they were defined benefit schemes, that they were large, and that they had a focus on external managers, so that there were similarities in terms of some of the practices and the opportunities and challenges, frankly, that they have faced along the way of implementing their climate-related approach. Now, we set up 17 questions which were posed to these peers who all agreed to participate in this review and have received the overview of the findings. Kind of in return for that, they were also interested to see what some of these other approaches were. So the questions were grouped into 3 specific areas, and this is the framework also that we'll use for presenting the results. And this aligns with what we call the Mercer Framework for Sustainable Growth. It's a framework that we use with investors in terms of thinking about climate, but also any kind of ESG issue around kind of integrating those issues first into your outlook and your investment beliefs, and then into your processes and policies, and then starting to look at the portfolio and how they can be best reflected in the portfolio. And we really find that by setting up a strong governance structure and shared beliefs and processes around certain issues, it makes it easier then to think about what you should do in the portfolio and how that should be implemented. And you spend a little more time up front, but then you spend less time, debating specific strategies, because anything that you do at the portfolio level is already grounded in that strong kind of belief and process development that's already been undertaken. So you can see that we asked a number of questions around, from the belief perspective, what kind of board education has taken place? Have they articulated specific investment beliefs that relate to climate? And also kind of ESG and long horizon investing is clearly closely aligned with that as well. From a process perspective, we ask things like whether the investment policy statements refer to climate, to what extent different investment manager agreements integrate a consideration of climate, what kind of reporting managers are doing on that front. And then at the portfolio level, 2 categories of questions. One around risk assessment. So to what extent have top-down or bottom-up kind of risk assessments taken place? And then from a risk reduction perspective, to what extent have they, taken certain steps to look to reduce different types of climate change risk? Now, this is a connection as well to the information that you received at your last meeting from Trucost in terms of the carbon footprinting analysis and results. So understanding your exposure to carbon emissions, of course, is not the only source of climate-related risk, but it is kind of a key metric that more and more investors are looking to have access to. And some investors are taking action on, as we'll talk about in this presentation, in terms of implementing a decarbonization approach, where you use your information about carbon emissions to tilt away from higher emitting companies. So that's one specific way that some of your peers are using that carbon footprinting information. Another kind of key driver for more investors to calculate their carbon footprint and access that information is around a push for more reporting of that information. And I know that the next agenda item with Mike Garland is going to talk about the Financial Stability Board Task Force on Climate-Related Financial Disclosures. So that's something that was set up 2 years ago by the Financial Stability Board, which is made up of G20 finance ministries and central bankers who are focused on managing global, systemic risk. And 2 years ago, they set up this task force focused on climate, because of a concern that a lack of clarity around climate pricing, different market perceptions around climate, a lack of information to climate-related data could be a source of financial instability. So they set up this task force. I'm actually one of the task force members. And the recommendations came out a number of months ago. And one of the recommendations is that asset managers and asset owners, including pension funds, begin to report on their carbon footprint. So, of course, having that information then is required should you wish to implement that element of the task force recommendations. And really the idea is to make all parts of the investment chain, from companies to asset managers to pension funds, have more access and availability to that type of information, all the way through to the beneficiaries of the fund. So that's another reason, another way that carbon footprinting information can be used. So that's really the connection to the last session. Okay, so these were the 17 questions that we posed. Now we're just going to go through some of the key results. So around investment beliefs. So some of the key things that came through from these 8 peers were first and foremost that developing a climate change strategy is consistent with fiduciary duty. There was a strong sense that climate today and increasingly in the future will become an increasingly material factor and something that investors should be aware of, should have a strategy around, that's aligned with prudent fiduciary oversight. Most of the peers have specific investment beliefs on climate change, and most of that, or a lot of that mandate was driven from the board. in a lot of these organizations. And last, and Alex will talk a little bit more about the differences between transition risk and physical risk related to climate. But transition risk is the risk of, created through the transition to a low carbon economy. Different sectors and companies, of course, will be significantly impacted by that. And that's the main focus for most of your peers in terms of how they're looking at managing climate risk. The other category of risk, of course, is physical risk and the impacts of increased storms, extreme weather events. So that also is included in the overall climate approach of many peers. But in terms of the practical actions that they're taking, it's less of the focus than transition risk. So you can see over here a lot of kind of green, which would suggest, strong progress from the peer funds on investment beliefs. A couple of examples, one fund, a European fund, kind of fundamentally reviewed its role and the role of finance and investment post-financial crisis, and thinking about the potential impact of climate is a key part of that. And another fund actually has set up regularly scheduled education sessions for the board on climate, to make sure that there's ongoing education around, a lot of the progress that we're seeing. Clearly, it's a quickly changing landscape in terms of what actions are being taken by governments, by states, by cities, by companies, by investors, and the different types of information and data that are available to understand this risk and manage this risk. So one of the peers has actually said, look, twice a year we're going to come in, have external groups of different types come in and do ongoing education. As we move into process, we see a number of those peers who've taken their kind of investment belief development and formally updated their specific investment policy statements to focus on climate to some extent. And many of those have also explicitly shared their climate-related strategies and beliefs and expectations with their external managers. So for new managers that get hired, they need to kind of agree to what those expectations are. And with existing managers, the practice is typically to kind of share that information, understand where the current managers kind of are on this topic, what processes and reporting they might have in place, or they may be developing, because it is an area that a lot of managers around the world are currently developing and improving their intellectual capital around climate risk management. Communicating with external managers, of course, is key. We also see a number of peers, and I know this is something that your organizations are focused on as well, collaborating with other organizations, particularly on shareholder engagement. We've seen a huge growth over the last few years of collaborative engagements by institutional investors with companies. So the Climate Action 100 really pushing on the largest emitters in the economy to reduce their emissions, to evolve their industrial processes, their business plans around that. So that kind of push on the corporate sector is something that, of course, is more effective if it's done jointly by investors in terms of having a louder voice, but also being more efficient for the companies. It's much easier for them to deal with one group than it is to deal with competing investor requests for meetings or slightly different recommendations and things like that. So we've seen a large growth around that collaboration in terms of corporate engagement, and also in terms of encouraging regulators and policymakers to take certain steps around climate. So those are some of the increased practices that we've seen. A couple of the peers have set up kind of cross-asset class internal sustainability or climate-related working groups to really kind of help to increase the level of knowledge and awareness and coordination within their organizations. A number of the peers have already said that they will adopt the Task Force for Climate-Related Financial Disclosure recommendations that I mentioned that have been put forward by the FSB. And as I mentioned, a number of the peers have encouraged or are now starting to require their external managers to adopt specific requirements or commitments around climate as part of working together. Now, the third area is around the portfolio. You can see that there's kind of less green here, which means that while many of the peers are looking at what they're doing at the portfolio level, a number of them have made commitments, often those are still in the progress of kind of the process of being fulfilled. So we see top-down climate risk assessment, such as the one that you'll be undertaking with us, is really an evolving area. Right, it's a new tool. Looking at climate scenarios and how they could impact long-term asset allocation isn't something that most investors are doing already. Many investors are using other kinds of scenarios to look at other factors, but climate is still relatively new from that perspective, but something that we're seeing kind of continue to grow. 5 of the 8 peers have a specific decarbonization goal. So they've set out either a kind of shorter or a longer-term decarbonization target that they're working towards implementing. However, none of them have put in a strict kind of fossil fuel divestment policy. So while they may be getting towards that in terms of their decarbonization goal, none of these 8 funds have said that they'll be completely exiting from fossil fuels. All of the peers have invested in sustainability-themed investments. So looking at the types of companies and assets which will do well as we transition to a lower carbon economy. So some of those peers are already invested in those, and in fact, most investors or all investors that have an infrastructure portfolio will typically already have exposure to renewable energy infrastructure. But many peers have increased their allocation both to renewable energy and sustainable infrastructure, and also sustainable assets more broadly across asset classes, whether they're looking at equities or green bonds in different areas. So that's definitely a growth area. So Peer B is using scenario analysis similar to what you've done, but actually taking it a step further and looking to kind of capitalize or look at the near-term potential shock to the fund if we go down a certain climate scenario pathway. So Alex will talk about the different climate scenarios, but of course, a successful implementation of the Paris Agreement will have considerable impacts on the economy, and what kind of impact might that have for long-term investors if we see a really swift change from that perspective? So that's something that one peer is looking into. Another peer is really focusing on corporate engagement. Initiatives like the Climate Action 100 that I mentioned, in terms of really using their leverage and trying to push companies to decarbonize instead of divesting from those companies in the portfolio. So that's a strategic approach that peer has taken. Okay, so in terms of the types of portfolio actions, we thought it would be helpful to just set out this slide and really capture the different types of activity that peers are using. And typically peers have a combination of all of these tools in their overall climate risk strategy. So the three categories on the left relate to the portfolio, to your specific investments. So one is integration. So from your perspective in terms of your asset allocation, your investment policy, but also how you select your managers across all asset classes and what you're asking them to report to you on. To what extent are you integrating a consideration of climate into that? That's really a very strong focus for many peers. Decarbonization is the next tool, whether that's tilting away from companies or excluding specific areas is another kind of core tool. And most of the peers are excluding things like thermal coal, but as I mentioned, none of them have gone to fully exclude all fossil fuels. Investment, another incredibly interesting and important area from our perspective, where we're seeing a growing number of interesting investment opportunities around the types of companies who are going to succeed in a lower carbon economy, who are looking at things like green building materials, who are doing more with less from an energy efficiency perspective. There's lots of opportunities, not just in energy, but across all sectors, at looking at those kind of emerging technologies and the types of investment opportunities that offer. So those are the three areas really in the portfolio perspective. And then on the engagement side, there's really, as I mentioned, the company engagement, but also the kind of capital markets engagement, where it's encouraging the types of structures which will allow for electric vehicle implementation or infrastructure implementation, and the different types of opportunities that will help us to transition to the lower carbon economy or make those investment opportunities more stable for long-term investors. So that's really the range of different types of portfolio actions that we're seeing the peers use. Now, coming back to the beliefs, processes, and portfolio framework, this slide really shows some of the key takeaways in terms of what are the specific activities that the peers are undertaking in each of these types of categories, which could then influence next steps for your organizations in terms of further developing your climate strategy. So as we've talked about, continuing the board level education, formalizing investment beliefs, reflecting those in your policy documentations, in how you review your managers, in the kinds of information that you ask them to report to you. We have one of the peers, requires that all of their managers report on the carbon footprint of their different investment portfolios, for example. Another peer is increasingly looking at other areas around the, how much revenue of the companies in the portfolio is associated with the transition to the low carbon economy. They're looking at that as something they'd like to see rise over time. So trying to create some of these new metrics and ways of reporting. So what are the opportunities from that perspective? And just kind of kicking the tires in terms of different managers. To what extent are they looking at this area or not, and what information is that providing to you? And then looking at the portfolio level in terms of either, tilting towards the solutions providers, some of the areas that we expect to see grow in the economy as we transition to the lower carbon economy, and also looking at things like physical risk, where you have exposure to real estate assets, to infrastructure assets. To what extent do your managers, kind of look at the physical resilience that those assets have to increased incident of extreme weather events? To what extent are they using those different kinds of climate scenarios on the physical warming side to make sure that you have the protection that you need in terms of those different assets? So those are the kind of specific actions that we're seeing among the peers. And really the final slide in this section in terms of some of the key takeaways that we've seen around how the peers got to where they did. As I mentioned, we see more progress around the beliefs and the processes, and a lot of the portfolio actions are really still kind of in the process of being implemented. We see that there's no kind of one way to do this. There's no one size fits all. It really does depend on the structure of your organization, how you're already invested, how you can evolve accordingly. Clearly, you're not starting from scratch here. You have a fully invested portfolio. How can we evolve that from a climate perspective is really the question at hand. Many of these funds have been working on this topic for years. It's not something you kind of come in and develop a strategy and leave. It's something that becomes part of the ongoing discussion, so that you could expect over time, as you come up with new mandates, you select new managers, this is a part of what you discuss with them. So it's something that kind of develops and evolves over years. The truth is, where external managers are involved, it actually takes a little bit longer because, of course, you're working with additional parties who will have any number of different kind of views and ideas on this topic. So really, starting to discuss it more with them is really the first key step from that perspective. And finally, really, being ambitious on this topic, being creative around thinking about the different opportunities and the best way forward for your organization in collaboration between the boards and the staff is really a critical success factor in terms of how the other organizations have made progress over time. So with that, I'm happy to take any questions about the peer review and the different findings from anyone before we...
Any questions at this point for Jane? Yes, Henry. Just identify yourself, Henry, please.
Good morning. Henry Garrido, DC 37. Now, you made a point, at some point you talked about decarbonization different from divesting from fossil fuel. Where did you see the discernible boundary between between the two? Because essentially, there has to be a point where risk has to outweigh your policy, so to speak. Was there anything in the findings that would lead you to believe that there's a point where that decarbonization would lead you to divesting from fossil fuel?
Sure. So I definitely agree that it's a spectrum, and all of these peers have spent a lot of time thinking about their approach to climate change. And so 5 of the 8, as I mentioned, have specific goals around decarbonizing, and a couple of the peers have actually said that they would like to align with the Paris Agreement and successful, achieving the Paris Agreement and the 2-degree goal that's aligned with that. So as they move away from, as they decarbonize, they're moving away from their exposure to the highest emitting companies in each sector, who many would feel have higher risk exposure as action is taking to reduce emissions. The higher emitting companies, of course, will need to change, and so that's one reason for tilting away from them. They also significantly have significantly lower exposure to fossil fuel reserves through their decarbonization strategies. And again, that's kind of a risk hedging perspective. If you look at the long-term energy outlook for what a 2-degree scenario, the energy use aligned with that, it's significantly lower, but it's not zero. There still will be, the use of fossil fuels in the economy. So the funds typically would be trying to align with the exposure to the lower cost reserves, which would be the ones which would be tended to be accessed, while tilting away from the higher emitting companies and the higher cost reserves, fossil fuel reserves, which would be more at risk under that scenario.
Yeah, so I guess this is a follow-up question. Yet none of the funds that you looked at had a divestment approach.
They had elements of divestment, so
elements, but not, flat out.
Not flat out.
Yank the whole thing out, right?
Yeah.
None of the.
None of
right?
these 8.
So it was a gradual approach as you turn your investment to decarbonize, but not necessarily you just pass the resolution, you're done, right? None of that.
Right.
Okay, thank you.
Shane, Scott Evans, Controller's Office, just to follow up. When you say they're tilting away from high carbon, let's say they're in the oil exploration production sector, they're underweighting high carbon companies and overweighting lower carbon companies, but they're still within the same industry and they still own them all for the most part. So it's a question of tilting the weightings versus the benchmark, and that's what you're referring to, correct?
Yep. For the most part, there are different versions of decarbonization. Right. Some investors maintain their sector exposure and tilt within each sector. Other versions of different low-carbon indices that are available do have some sector.
Right. They might underweight the sector, but they would still, they'd own less Exxon as opposed to just divesting from Exxon. Yeah, thanks.
Yeah.
Aldrin? Who are you?
Oh, Aldrin Bonilla, I'm Hamburg President's Office. Anisis trustee. The sustainability-themed investment opportunities that you mentioned seems to be a key component of overall toolbox, if you will, the strategy. How mature or evolved is the sustainability, for example, asset classification system? How does it exist? And then what can we foretell in terms of benchmarking?
Yeah, it's a great question, and it's so I'll take them in order. In terms of the investable opportunity set, from our perspective, it's robust, particularly on the listed equity side, and it's a little smaller, but it's there on the private equity side, and as well on this kind of sustainable infrastructure side. In terms of how to kind of identify the universe of different companies that would kind of qualify, it is more challenging. So if you look at the GICS, sectors, as part of the MSCI index, a lot of the kind of low carbon solution providers that you would find in some of those sustainable investment funds would be in industrials. They wouldn't necessarily be split out in a way that you could easily identify them. And I think that's something that we're seeing a lot of work in the industry to kind of look at the metrics that I talked about around, how much of your revenue is associated with energy efficiency or green buildings or, those kinds of things to really create that universe. But right now there are, a number of kind of active managers who have those universes of companies who are putting those things together. But it's not something that we would suggest you kind of try to take an index and access from a passive perspective, because it's quickly changing and some of those metrics aren't really worked out as well as they will be over time. So from the listed equity perspective, private equity perspective, we see interesting investment opportunities. And then on the infrastructure side, this is, I think, a really important area that a growing number of large funds who are focused on, climate are really thinking about, as well as a lot of the different development banks looking at how to facilitate more investment directly into sustainable infrastructure in emerging markets, where we know that something like 70% of emerging market emissions will come from infrastructure assets that will be built over the coming decade, but we don't know what kind of infrastructure that will be. And so the more that we have long horizon investors who are interested in investing in sustainability-themed infrastructure in emerging markets, the more that we can look to influence what is built from that perspective. But investing directly in emerging market infrastructure isn't something that all investors are comfortable with. So many multilateral development banks are looking at how they can de-risk those investments. I think that's a growing investment opportunity set, and something that over the coming few years there's kind of increased opportunity to look at.
Umair.
Good morning, Umair Khan for the Public Advocate. In your presentation, you have peers A and D affording or adopting the Paris Accords, or the 2%, 2-degree benchmark. Using the overweighting and underweighting strategy, does that get you there?
So they also have an element of targeting specific investments into the sustainability-themed kind of solution providers, in addition to tilting their portfolios kind of towards the lower emitters. Each of those funds has also kind of an active approach to specifically allocating capital towards kind of the low carbon solution providers as part of the overall strategy, along with the engagement elements that I talked about, both very strong company engagement, but also working with policymakers and regulators to kind of provide a voice in support of the types of instruments and regulations that need to be introduced to actually enable successful implementation of the Paris Accord. So it's really all of those elements together form their 2-degree kind of aligned investing approach.
Other questions for Jane? I just want to ask one question, Jane. In terms of thinking about decarbonization, I have been thinking about it in sort of 2 buckets, but I want to make sure I've got this right. First of all, we have the exposure to fossil fuel reserves, right? But that's kind of, that's one element. But then the other element is carbon emissions, right? They're not really the same thing, right? You don't measure them the same way. And so when we're thinking about decarbonization, am I right in thinking that we need to sort of think about both buckets, both reducing our exposure to carbon emissions and reducing our exposure to fossil fuel reserves? Is that an accurate way to think about it?
Yeah, I think that that's exactly right. And thinking about the role that each of those have, not only in your listed equity portfolio,
Sure.
but I think as different investors develop a philosophy around, look, none of us know exactly what's going to happen. None of us know, if we'll be successful in implementing the Paris Agreement, the different steps that will be taken at different times. But even the current path that we're on in terms of the different commitments that countries have made, we'll see a reduction in emissions and a reduction in fossil fuel use, right? So so logically you can take steps to think about which of the types of companies and assets in your portfolio will be the most affected by that, and to tilt away from those from a risk management perspective, just purely from a financial perspective. Right. And that's what most of these peers have done. Some of them have taken an additional step of saying, look, we want to be part of the solution and align with the 2-degree outcome because we think that that's the right thing to do, and it's the best financial thing to do. So, but even if you just take it from a financial perspective, looking at which reserves are most at risk, right, and which companies have the highest emissions, is a logical step down that path.
Okay, thanks.
Jane, Mike Carlin from the Controller's Office. Just to follow on, this is in the context of risk to the funds and how to manage risk, but in terms of the collateral benefit for addressing climate change, can you talk about the relative impactfulness of issues around fossil fuel reserves versus addressing and reducing emissions? I'm sorry, do you understand the question? That where I'm trying to get you to is the fact that by reducing company emissions, that's having a direct impact, correct, on the ability to hit the Paris Agreement goals in a way that lowering your fossil fuel reserves wouldn't?
Right. Okay. So in terms of why some of the peers have chosen an approach to engage with companies and encourage them to significantly reduce emissions as opposed to just taking them out of their portfolio is definitely partly because, look, even if you decarbonize your portfolio but you don't decarbonize the economy, then you're not kind of aligning with the 2-degree outcome. So that's definitely been a driver for that type of engagement. And that, the reality that all of these peers are, kind of universal owners. They're all exposed to, all sectors and asset classes around the global economy. So it's very difficult to isolate and protect your portfolios from, wider economic impacts that are associated with climate change. And so that's another driver for why, active engagement with companies to address the issue head on is a sensible strategy.
Any other questions for Jane? Keep in mind that we still have another half of this presentation
Yes.
to go with Alex. Okay.
over
and
to
I'm
you,
sure
Alex.
Jane will still be here if there are other questions for
Yes,
her after
of course.
Alex's part.
Right on. From one dense topic to another. We'll make it light, hopefully. I'm Alex Bernhardt, Jane's colleague with the Responsible Investment Team at Mercer, and we're going to talk a bit more now about our climate change risk assessment modeling approach. This is meant to be, as Jimmy mentioned at the beginning in his introductory comments, a primer on our risk modeling approach, and we'll present our methodology, why we developed it, how it works, broadly speaking, and then we'll look at some sample outputs. But keep in mind, again, we're going to go into a lot more detail on the outputs of the model and the inputs to the model in January as well. So for some context first, I think it's useful to understand how we, broadly speaking, how we look at investment risk in portfolios using different processes, both top-down and bottom-up today, and how those apply in a climate change context. So broadly speaking, we've categorized a number of top-down and bottom-up investment risk management approaches here on this slide. You can see asset liability modeling shows up, asset allocation modeling being a key component of that, of course. You can look at manager monitoring and selection processes. All of those types of top-down inputs can really inform an investment risk management strategy. And then from the bottom up, you've got company and sector-specific analysis, as well as potentially geographic analysis, and an evaluation of a direct investment process. All those things can inform, again, an investment risk management strategy. And what you guys have done from a climate risk management perspective already is look at some company-level risk and some sector-level risk through your carbon footprinting analysis, which was presented at last month's meeting. What we will look at then is the asset allocation level risk of climate change using our climate change risk assessment model. Sure, yeah, sorry. Height challenged. So that which will be a useful supplement, we hope, to the carbon footprinting exercise. And both of those inputs to the investment risk management, both of those inputs can be very useful to developing a climate change investment risk management strategy, which is more holistic in nature and then takes into account both top-down and bottom-up investment decision-making processes. And so the reason why we developed our model is multifaceted, really. Primarily, that there was no real way before we worked in 2015 to develop our modeling methodology to isolate the impact of climate change at the asset allocation level. And so that was a primary motivation. A secondary motivation was that there are a number of challenges to addressing climate change risk, in part because of the time horizon over which climate change is taking place. It's a multi-decade risk, which is unfolding slowly. Certainly the physical impacts of climate change, so that the worst physical impacts of climate change aren't expected until later this century. And so it's very difficult to square the circle, if you will, to make that time horizon and that potential risk relevant to investment portfolios where we're monitoring risk at a more regular and short-term horizon typically. And so what we've done is developed a model which applies, we look at the 10-year horizon primarily, and you'll see some 10-year horizon results later on. We also look at the 30-plus year time horizon with our analysis, and it may even be relevant in future, but for the uncertainty around the climate change outcomes, to look even further out in time. But so what we've really attempted to do is bridge that time horizon gap by looking at the 10-year outputs. So keep that in mind as we move forward. in developing our climate model, the first thing we wanted to recognize is that there are a number of potential climate change scenarios that could eventuate. We looked specifically at a 2-degree outcome, a 3-degree outcome, and a 4-degree outcome. And these are all degrees centigrade above the pre-industrial average at the end of this century. The 2-degree outcome is the one associated with the Paris Agreement. That's the baseline goal of the Paris Agreement. And in that scenario, we would see a lot of what we call transition risk, which Jane referenced earlier. And this is risk to incumbent industries, likely those which have either produced fossil fuels or are very carbon intensive, to disruption from policy action to, say, put a price on carbon, or technological advancements in renewable energy or energy efficiency, which might cause that disruption to happen. Transition risk is a much more present danger or near-term danger to investment portfolios, relatively speaking. On the 4-degree side, where we see unmitigated climate change, business as usual, basically, where Paris Agreement is not implemented, our current policy commitments, which align broadly with a 3-degree outcome, are not implemented, and we have unmitigated climate change. Physical risks will be much more severe. However, those physical risk impacts aren't going to be felt or visible for several decades as yet, at least in their severest sense. We're already seeing some physical impacts today, but the worst impacts aren't going to be expected for several decades. The difference between those two risks is time horizon. Also, on the transition risk side, you'll see that that's typically a much more controlled risk. It's something that we have the ability to legislate for or to invest in to an extent. On the physical risk side, it's much less controlled and more uncertain. So again, 2-degree, 3-degree, and 4-degree scenarios. And we'll focus in our analysis on the 2-degree and the 4-degree outcomes because those are the tail risks, really the more severe impacts. And we'll ignore the 3-degree for practical purposes. And so we also recognize, after developing these scenarios, that climate change is not just a risk. And if you look at it as this single risk, it can get very confusing and not difficult to apply to an investment portfolio context. And so what we did is we devised 4 separate risk factors, which we call affectionately the TRIP factors, because we're fond of acronyms. And they're called the technology, resource availability, the impact of physical damages, and policy. And so the T and P factors on the far ends of the acronym there are the transition risk factors. So the technology, again, the risk of disruption from, say, a runaway successful renewable energy technology to incumbent industries, again, and then policy being, say, again, a carbon price. And then on the physical risk side, there are two different types of physical risk, broadly speaking. You have resource availability, which is really the risk of long-term shifts in weather patterns. So seasonal or annual or even decadal shifts in precipitation or temperature change causing impacts on businesses. And then on the physical damages side, this is really more severe or acute weather events like floods and hurricanes, and the risk that the frequency and severity of those events might shift as a result of climate change. And so we've taken pains to identify the sensitivity of individual industry sectors and asset classes to each of these risk factors. And I've shown here on slide 22, these are all the various asset classes which the New York City pension funds collectively allocate to, and their TRIP climate sensitivities. And so what you'll notice is that there's some dark red under the I factor that typically orients towards real asset classes, which are much more directly exposed to the physical impacts of climate change. And you'll see the T factor is largely tilts toward the green side, which means there's a positive impact from technology innovation on most asset classes, and this is our ingoing expectation for the model. But again, broadly, these risk factors describe the sensitivity across scenarios of each of these asset classes to these risk factors. And so what we're able to do with our scenarios and our risk factors is somewhat simplistically tie together those sensitivities to the scenarios. And so what we've done is in each scenario defined the relative influence of each of those risk factors over time. And so in a 2-degree scenario, in our transformation scenario, the T and the P factors the transition risk factors are going to be much more influential than they would be in a 4-degree scenario. And so those differentials are predefined in the model. And it's a simple aspect of applying the relative sensitivity of each of those risks, the relative sensitivity of each asset class to those risk factors by the relative importance of those risk factors in each scenario to come up with total portfolio outputs. So to describe briefly what those outputs look like, we have a sample outcome here for one of the pension portfolios. Not important which at this point. We merely want to use this again as an example of the output to orient you better for the January board meeting. Yes.
And Alex, if I may just say that the specific scenario results for each pension fund is in Convene. They have access to their own
right.
funds
Correct.
scenarios.
Yes. Thank you. And so what we're showing here on the left is the 10-year average annual return impact under a 2-degree scenario. And on the right-hand side of the slide is the 10-year average annual return impact under our 4-degree scenario. And what you can see, the noticeable takeaway here is that the 2-degree outcome, the relative impacts on the asset classes is much more significant in both directions. And sorry, let me take a step back here. Describe how to interpret these circle charts. So each circle represents a total portfolio. The width of each colored bar is the size of the allocation of the portfolio to the asset class. And then the direction of the colored bar describes the impact on the asset class in terms of average annual returns. And so if you're going outside the circle with the colored bar, that means a positive impact from climate change. If it's going inside the circle, that means a negative impact from climate change. And so the more severe or significant the movement in and out of the circle, the more significant the impact of climate change on the portfolio or the asset class. What we see in the 2-degree scenario here is there's a significant movement both in and out of the portfolio, and those offset each other somewhat. You can see public equities have a drag in the 60 basis point range on an annual average return basis, again, over that 10-year time horizon, whereas real assets, so core real estate and infrastructure, have a gain. And those offset, in part, those public equity impacts. And so what you see is versus the base case, so we ran our model without these climate change risk factors turned on, and then turned the climate change risk factors on and compared the two. So versus our base case analysis, you see about a 30 basis point overall portfolio return drag over that 10-year time horizon. And that we can translate that into cumulative dollar impacts as well, but we're showing just the base case comparative return value here for now. For the 4-degree scenario, you can see that the total portfolio impact is much more muted. It's about a third the amount of the 2-degree impact. And this aligns with our understanding that the physical risks associated with climate change, which are going to be more severe in a 4-degree scenario, haven't really taken place in 10 years. They're going to be much more severe in 20, 30, 40, 50 years. And so we're not seeing that long-term risk in this particular portfolio analysis at this time horizon. But the real key important thing here that I want to drive home is that these absolute numbers should be less of the focus, and what we should really be focusing on primarily is the relative impacts of the scenarios across the portfolios, and also the relative impacts of the asset classes from the climate change scenarios. So I'll stop there for a moment, and we'll have questions before we talk about, I think, next steps.
Questions for Alex on this so far? Aldrin?
I understand you mentioned the 30, 40, 50 year out in terms of the long-term.
Is your mic on?
Yes.
Okay.
Can you help me understand a little bit of the fragmentation, the 4-degree scenario? Seems a little bit counterintuitive to me that the scenario will be more muted than the 2-degree scenario.
And that makes perfect sense. So the main reason is because there's very limited transition risk in a fragmentation scenario, because there's been no policy action effectively to limit carbon emissions. There's been limited investment in technology to reduce emissions and to see us on a pathway towards 2 degrees. And so because there's little transition risk in the short term, there's very little disruption to investment portfolios. What's also not being shown really is the physical impacts that a 4-degree scenario will eventuate, right, over a longer time horizon. So it's starting to show. You can see there's some impact, but it's not significant.
But even a 4% scenario in a 10-year span, the physical impacts in such a short period of time are such a
nominal. It seems relatively nominal.
Will seem very troubling, even from just I mean, I think we'll have bigger problems to worry about, with, in a 10-year period with a 4% degree scenario.
Yeah, and that's a great point. And there's certainly considerations for longer term, right? Every time emissions are very sticky and they stay in the atmosphere, and there can be a lot of inertia and harder to turn the global economy towards a lower degree outcome over the farther we go out on this business as usual trajectory, for sure. I would say that the fragmentation scenario or the 4-degree scenario is challenging. This is part of the reason why we wanted to develop this modeling approach, is because the way that the physical risks take place or unfold is very challenging for us to understand as investors. And also, I say we analyzed in a lot of detail the potential physical how these physical impacts translate to economic impacts, which then will translate to investment impacts. And because there's so much diversity in some of these asset classes, like in public equity, the physical impacts are going to be muted by the diversity of the public equity asset class, by the fact that there are dozens and dozens or thousands and thousands of individual properties underlying those companies that are in public equity exposures, that it doesn't really carry through at the asset class level. At the sector level, you see a little bit more impact at the 10-year time horizon for fragmentation, but we're only showing the asset class level results here. I hope that was a useful response. Okay.
Other questions?
Right here.
Eddie, just introduce yourself.
I mean, years ago I read
Eddie,
this
who are you? Who are you?
I'm Eddie Brown.
Thank you.
I'm surprised you don't know that.
I'm slow.
Years ago, I read this article. In other words, like copper was the big thing, right? Wires, everything you needed for telephone wires, copper, right? Now it's fiber optics, right? So the technology catches up with this stuff, all right? They put fiber optic across the ocean, so that eliminates all the copper that we thought we used to need, right? So now you got the electric cars, you got all this. Isn't the technology going to catch up with this carbon footprint with the gasoline and all this stuff in the future?
I hope so. I mean, can you refine the question a bit? So what's
in other words, if you would have told a guy to invest in copper in 1950, you say every wire you need for the rest of your life is copper, right? And then fiber optics came, and that was BS, right? So now you're talking about the big 3 automakers I read the other day. They're saying, not so fast, Tesla. We're putting where you can charge your car up in an hour all over the country because we're catching up. Right?
Yeah. Okay. So you're talking about the risk of potentially trying to pick winners in the technology space.
No, I'm saying that you're talking about global warming, climate change, right? Mm-hmm. Is the technology going to change what we're worried about anyway?
Yeah, I mean, it may well. I think the way I'm interpreting your question is that
they're talking about in 2020, they're taking all the gasoline cars out of California. Am I right?
Yes. So there's definitely a number of global emission standards and electric vehicle production standards in China and in Germany and in California, as you referenced, which should have an artificial impact on, if you can call it that, on electric vehicle production and increasing that. That creates technology opportunity for investors in electric vehicles or electric vehicle manufacturers or component parts for electric vehicles, but it also creates risks for incumbents that aren't able to transition or adapt fast enough to that transition, which is being imposed.
But doesn't that change the risk for climate change of what we're talking about?
I think that sort of risk will become more pronounced in a 2-degree scenario, and it'll be really important if you see that kind of a scenario becoming more and more likely to manage that risk appropriately in your portfolio, for sure. And that if that technology risk becomes more pronounced, then you're going to want to hedge it and also maybe capture some of the upside from it as well. Try to by allocating to sustainable opportunities, which are really oriented towards those technology advancements and taking advantage of them.
Other questions for Alex at this point? Henry?
I have a question on both scenarios. You look at bank loans, for instance, as potentially losing. Did you look at these scenarios and then extrapolate specific asset allocations as, or, as a rebalance to this approach? I'm wondering why in both instances you show, in both scenarios, you show almost like status quo. I think it goes to the question of adjustment. Is there not an adjustment within a 10-year period that you would make? I think somebody was mentioning
Yeah.
to rebalance this.
What's that?
The next slide, talk about
Oh, sure.
one of the things we're going to do is the
Yes. Well, so I think there's two elements to that question. One is in our analysis, we've assumed that the asset allocation would be stationary over time, so that we can isolate the impact of climate change on your current allocation, and that'll then inform you, how you might change your asset allocation in the future. And to further inform that decision, what we're going to do as sort of the next steps for the project is take your current allocations, modify them slightly to include some allocations to lower carbon or sustainable themed assets, and then see what the impact of that might be on the total portfolio outcome under these certain scenarios.
Yeah, I think that would be very helpful.
Yeah, and so that's some part of what you'll see from us in January.
So Alex, let me suggest that you go ahead and finish up your presentation, and then we'll see if there's any questions at the end, but we are starting to run up against time limits.
Sure.
Thank you.
Thank you. The hook. So yeah, as our next step, we will be working with BAM and the boards as appropriate to identify alternative asset allocations to model with allocations to carbon risk management strategies, broadly speaking. We'll then update the climate risk assessments that we've done for the current asset allocations already to include these alternative asset allocations, and then we'll provide a report with including our recommendations around a variety of investment process and portfolio outcomes related to climate change risk, and then we'll present the summary findings of that report to this group in January at the appointed meeting date. So thank you very much for having us here today. Appreciate it.
Don't go yet. Are there any other questions for Alex or for Jane? Yes, Dave. Who are you?
Dave Katzman, TWU NICERS. Yes, Jane and Alex had 2 slides they haven't yet presented, or at least I think it's in their pack, on TCFD.
Oh.
Okay.
The appendix?
Yeah.
And I think that might be something we would be interested in hearing about.
Sure. Happy to do that.
Okay, go ahead. And then Mike, you'll come up as well.
So these were in the appendix. So the first slide here is really just kind of setting out the overview of TCFD. So I gave a little bit of background to this earlier in the presentation. So the TCFD was set up by the Financial Stability Board, really to consolidate all of the different disclosure frameworks that exist already for companies to be disclosing how they're managing climate-related risks and opportunities, and also to push the investment chain, so both asset managers and asset owners, to also be more proactive and transparent around both asking companies for information about how they're managing climate risk, but also disclosing themselves through the investment chain, so from investment managers to their clients, and from pension funds to their beneficiaries, to create transparency across the full investment chain around climate-related risks and also opportunities. There's more and more literature out there talking about, the significant opportunities that are associated, and I think to the point made earlier around, there's lots of winners that are associated with, all of the new developments that we're seeing in different sectors. So really, it's that kind of a framework. So the recommendations were put forward. There'll be another announcement around the December 12th Climate Summit in Paris around more signatories who are adopting the recommendations, and Mike Garland Alan's going to talk about that in a couple of minutes. And then the next slide really just sets out what the framework is. And it actually aligns nicely with the framework that I presented earlier around, beliefs, process, and portfolio. It's a similar kind of structure around having, the governance, so who's responsible for climate risk, how is it managed in terms of boards and management teams, what is the overall strategy, what kind of risk metrics are in place. Specifically, there's a question around how climate risk management processes are integrated into broader risk management processes, because part of the push is really to integrate climate as one of the many kind of relevant considerations that investors need to think about. And then the last one is around metrics and targets. And the specific metric that's put forward for investors is to, at a minimum, report their carbon footprint. But also, there's an encouragement in the report to report other metrics that that you're looking at, that you find useful and relevant, very much recognizing that it's a work in progress and it will evolve over time. Okay.
Okay. Mike, did you want to address something right now, and then we'll finish up with any questions, both on this and on Mercer's broader report?
Sure. Thank you, John. Mike Garland from the Comptroller's Office. That was a perfect segue. And I promise to be brief. I want to respect everyone's time. But we received a request this week that the New York City funds, or some subset, endorse the task force recommendations. So as Jane mentioned, they were released last June. And there were over 100 supporters who signed on at that time, many large pension funds, CalPERS, CalSTRS, Ontario Teachers, many companies, Citigroup, and PepsiCo. The French are convening a climate summit, and on December 12th, they want to announce a new round of supporters to build momentum. And so we would need to get back to them by December 1st. Just a couple quick comments. We are already encouraging portfolio companies to report consistent with the framework. This is a helpful slide that talks about the key components. It does have, first of all, this is purely voluntary, but it does have implications not just for our portfolio companies, but for asset owners and investment managers. And the exercise you're going through today really addresses a lot of the components. So the strategy component, the asset owners, the scenario year analysis that Mercer is doing is consistent with that component. Risk management for asset owners that addresses some of the engagement activities that the funds undertake, metrics and targets, the carbon footprint exercise. So I'll be sharing with Susanna and John additional information with each board, and then recommending that you approve signing on. If all 5 systems do it, we would do it collectively as the New York City pension funds. If some subset does, then individual funds could be signatories as well. So I don't know.
Mike, is this something you want us to take up in the caucuses today?
Well, I think that to respect the time on a busy day's agenda, since we have until December 1st, we thought we would reach out by email. We could send an email out and follow up if that works for everybody.
Okay. Great. Thanks.
Michael.
Yes.
Question. Was there a question?
John Farina Fire. Would you be able to tell us who made the request that you're referring to?
Yeah, I got a call from somebody who, his name is Curtis Ravenel, is the person who, so the task force is chaired by Michael Bloomberg. There's dignitaries like James Ambikshire on as well. And so he's the key, I think the sort of the front staff person with Mark Carney, who the chair of the Bank of England and who convened the task force. And so he made the request.
Okay, other questions for Mike or for Mercer? Umair.
Umair from the Public Advocate's Office, Mr. Chair. My understanding from the RFP was that it would take 3 months for the initial analysis and then 3 months for the Mercer analysis. And so now we're looking at potentially this coming out in February with the final understanding. Could you kind of tell us perhaps what might have changed the timeline, and whether it's BAM or from our advisors here, as to perhaps why there's it might be taking longer than anticipated?
Yeah, I'll respond. This is Jimmy Yan from BAM. The commencement of the contract didn't start until later, much later than we expected. So there were just a few different contracting delays based on a few various issues. So, we're sorry we weren't able to get that started sooner, but really it got to a later start.
There were delays in getting the contract registered, but that's now been done.
Any other questions?
Yeah, so
Joe,
Joe
who are
Alejandro,
you? Thank
New
you.
York. Take it easy. Give me a second, all right? You act like a traffic cop. All right, take it easy. Joe Alejandro, New York City Police. So we're getting the report today, and I appreciate all the work it seems that you've done. And obviously, we're all concerned about our environment. We want to be here a nice long life. We don't want to choke on smog, and we want to have sustainable food supplies and everything else that comes with that. But my concern is now it seems like there's now a pressure here to vote on this, to get going, because there's an announcement that's going to be made by France or whatever. And so I'd prefer to look at this material another month or so before I even think about voting on it and approving it. That's my concern. It's a reasonable concern, I think. I'd like to have time to decipher this. I appreciate, again, I'm not saying it's wrong. I'm saying it's time to review now, as a trustee, the work that's been done. And again, I thank you for an eye-opening presentation. Thank you.
Thanks, Joe, for bringing that up. Just to clarify, nothing is being asked to be voted on today.
Okay. Seems like it just seemed like that there was
Yeah.
an announcement that needed to be made, and we needed some time to think about
There's
this.
just one little sign-on letter that we're just sharing the opportunity with all of the boards to sign on to, and we'll give you full information, and we can take it from there, but no request for a vote today.
By the way, one more follow-up. Jane, you're the daughter of Keith Ambikshire, right?
That's right.
Who was brought in several years ago to try to convince us to put all our authority into BAM and allow them to run our programs with some resistance from some people in police and others. I know that. So I hope he's doing well.
And I'll just remind everybody that was during the previous administration.
Exactly, and unfortunately, he used OMERS as the example, and OMERS, I believe, is almost half invested in private investment, not public equity. So I said we can't do that by law anyway, so appreciate your input, but can't do it. So, and I'm sure you don't have that opinion, right?
No comment.
There you go.
Okay. Any other comments? Yes, Mike. Who are you? And speak into the mic.
Michael Palladino, DEA. So as we move further into the discussion about this, are we going to see the impact of the 3-degree outcome as well as the 2 and the 4? Or is there much of a difference, and what is it? Yes.
You will see that. We'll provide all of that information, but really there's not a lot of impact from the 3-degree scenario, which is no surprise really because it's kind of the path that we're on. So there's no real surprise with that outcome.
Okay, great, thanks.
Yeah.
Okay, any other questions? Okay, so just a couple more points of business here. First of all, if there are trustees that have arrived since we did roll call, could you please introduce yourselves for the record?
Good morning, Ray Sanchez, Bronx Borough President's Office.
You were here. You were? Okay, sorry. Yeah.
Michael Kraft, Burrs.
Okay.
John Kelly.
Did you hear that? Okay.
Jack Kelty, Fire.
Jack Kelty. Anybody else? Okay. Now, are the teacher trustees here? Can we have the teacher trustees come over, please? We're going to thank, let me just say, Mercer folks, Jane, Alex, thank you so much. Okay. Mike, thank you as well. So what we're going to do is we're going to ask for a roll call of the teachers' retirement system, and that will conclude our public business for this morning. We'll then ask each board to exit public session, go into executive session, and then we'll take a break. But don't take it yet, please.
I think we have to get them from outside.
Okay, let's get them in. Can I do?
Yeah, really hot, yeah.
Okay, so what we're going to do to speed things along here is I'm going to ask for a motion and a vote from each of the boards that is already in public session to exit public session and go into exec session. Then we'll do that with the teachers as well. So let's go in reverse order. Let's start with NYSERS. Is there a motion from the NYSERS trustee to exit public session and go into executive session?
Motion to go into private session.
Executive, please.
Executive session.
Thank you. Is there a second?
Second.
Okay, any discussion? All in favor at NYSERS of the motion to exit public session, go into executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries.
Is Tom here?
Birds?
Next, we have police.
Motion to go into executive session, Joe Alejandro.
Second, John Dawson.
Okay, any discussion? All in favor of the motion at police to exit public session, go into executive session, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, fire, is there a motion?
Leroy McGinnis, motion to go into executive session.
Thank you. Is there a second?
Jack Kelty, second.
Okay, any discussion? All in favor of the motion to exit public session, go into executive session at fire, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Okay, now teachers, good morning.
Good morning.
We're going to ask for a roll call at teachers. Patricia?
John Adler,
Here.
Thomas Brown,
Here.
David Kazansky,
Present.
Raymond Orlando, Deborah Penny, Susanna Vickers. We do have a quorum.
Thank you, Patricia. Okay, now that we're arrived, can we get a motion at teachers to exit public session, go into executive session?
So moved.
Is there a second?
Second.
Okay, any discussion? All in favor of the motion at teachers, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, motion carries. Okay, so we're all now in executive session. Please turn the...
I'm reporting out from the executive session of the NYSERS board meeting. The board approved the fixed income annual plan. The board also approved one real estate investment. They approved a pool of global active equity managers, which will be announced upon contract. They approved the use of the assets of a manager with an expiring contract to pay benefits and rebalance the portfolio. And they approved the updated thermal coal excluded company list. That's the complete report out.
Okay, thank you. That concludes our business today. A motion to adjourn would be in order.
So moved.
Is there a second?
Second.
Any discussion? All in favor of the motion to adjourn, please say aye.
Aye.
All opposed, please say nay. Any abstentions? Okay, the meeting is adjourned. Thank you.
During the executive session, the board discussed various investment matters, reviewed certain personnel decisions, and we made certain decisions about which candidates to hire, etc. Oh, now we need a motion to adjourn. Motion to adjourn. Second. Any objections? Hearing none, the motion carries.
During executive session, the trustees voted to move forward with the fixed income annual implementation plan, details to be made public at the appropriate time. The trustees heard a presentation from the comptroller's office and its consultants in the asset class of real estate. A decision was made, details to be made public at the appropriate time. The trustees heard a presentation from the comptroller's office and its consultants regarding global concentrated equity. A decision was made, details to be made public at the appropriate time. The trustees heard a presentation from the comptroller's office and its consultants in the asset class of hedge funds. A decision was made, details to be made public at the appropriate time.
So I make a motion then to adjourn.
Second.
Aye.
Aye.
There you go. Meeting's over.
3, 2. In executive session, an attorney-client's session was held. A implementation plan for fixed income was discussed, consensus was reached, which will be announced at the appropriate time. A real estate investment was presented and discussed, consensus was reached, which will be announced at the appropriate time. A pool of equity managers was discussed, consensus was reached, which will be announced at the appropriate time. Presentations from 2 global equity managers were received, consensus was reached, which will be announced at the appropriate time, and there was a discussion of specific securities.
Motion to adjourn?
So moved. Second.
All in favor?
Aye.
We're done.